Okay, let's dive right into a topic that's become pretty standard, in the crypto world.
Mm-hmm.
But it turns out maybe not everyone's on board. We're talking about companies publishing their on-chain proof of reserves.
Right, showing the wallet addresses, basically. Proving they hold the crypto they say they do.
Exactly. And, this really took off, didn't it? Especially after some of those big collapses.
Oh, absolutely. Think FTX, MGOX. There was this huge push for, well, real verifiable transparency. It felt critical for trust.
Totally. And you saw lots of big players, exchanges and whatnot, start doing it, saying, look, here are the addresses, check for yourself.
Yep, became almost expected.
But
Yeah.
the stuff we're digging into today, comments from Michael Saylor, he's the executive chair at Strategy now, used to be MicroStrategy.
Yeah, big Bitcoin holder.
Huge. Anyway, he offers this, surprisingly strong counter-argument.
He does. Speaking at an event recently, he didn't just, raise questions. He flat out called on-chain proof of reserves a bad idea.
A bad idea. That definitely catches your ear, especially coming from him, right, given how much Bitcoin his company holds.
For sure.
So our mission today, really, is to unpack why. Why does Saylor think this? Understand his logic and, see how it stacks up against this industry trend.
Yeah, try and get a more nuanced view on how companies prove assets and what the hidden risks might be.
Because it's easy to see why people want transparency, like you said, after everything that's happened.
Absolutely. But Saylor's focusing on security issues that maybe aren't immediately obvious when you first think about it.
Okay, so let's get into it. Why bad? What's the core of his argument against putting those wallet addresses out there?
Fundamentally, it comes down to security. He actually calls the usual way of doing it an insecure proof of reserves.
Insecure. So not making things safer, but
actively diluting security, in his view, making it weaker.
Weaker. How? And, for who?
Well, according to him, it creates pretty big risks for basically everyone involved. The company putting out the proof, sure, but
Right.
also the custodians holding the assets, the exchanges where things are traded, even, the individual investors.
Wow. Okay. So that's a strong take. It's not just unhelpful. He thinks it makes everyone less safe.
Precisely. He was pretty forceful about it. Said something like, no institutional grade or enterprise security analyst would ever advise a company to just publicly broadcast all their main operational wallet addresses.
Right. And he had that really striking image to make the point, didn't he? About AI.
Yeah, he did. He suggested, take an advanced AI, put it in deep think mode or whatever, and ask it about the security problems that come from publishing wallet addresses.
The AI way.
He claimed it would come back with 50 pages of security problems, just pages and pages outlining how it could undermine security over time.
50 pages. Okay, that's vivid. It paints a picture of a lot of complex vulnerabilities.
Exactly.
Yep.
It's meant to convey just how many ways this could potentially go wrong from a security standpoint.
So what kinds of problems are we talking about? Without getting super technical, what's the main danger he sees?
The core issue is really traceability. When you publish those addresses, you let anyone, including, bad actors, trace the money, see where it's coming from, where it's going.
Ah, okay. So it's not just seeing a big pile of crypto exists somewhere.
No, it's potentially much more than that. Attackers could map out specific wallets used for operations, track the flows, maybe spot patterns.
Maybe even connect those addresses to real-world stuff over time, like who controls them.
Potentially, yeah. It's kind of like publishing the blueprints and the daily guard schedule for your bank vault. Institutional security tries really hard to avoid that kind of visibility.
Right. That makes sense. It gives attackers information they wouldn't normally have about how you manage your treasury, your security setup.
Exactly. Information that could be gold if you're planning an attack, maybe trying some social engineering, or looking for weak points in their operations.
Okay, so security is the big one. Did he bring up any other downsides to this kind of proof of reserves?
He did make another really important point. It's about what this kind of proof often doesn't show you.
Okay.
It shows you what assets a company holds. The Bitcoin, the Ether, whatever.
Right, the assets. But, it doesn't show what they owe, does it?
Exactly. It's only one side of the balance sheet. You could see massive holdings, but if the company owes even more to customers or lenders...
Then that proof of reserves doesn't really tell you if they're financially sound or not.
Precisely. So even the transparency benefit, the whole reason for doing it, might be incomplete. It gives you some insight, sure, but it's not the full picture of solvency.
You really need to see both sides, assets and liabilities for that.
Correct. It's valuable info, but it's definitely not a replacement for a proper, comprehensive audit.
Now, it was mentioned in the source that when Saylor himself was asked if Strategy holding, over 576,000 Bitcoin now, apparently?
Yeah, a massive amount.
If they would publish their proof of reserves, he didn't give a straight yes or no.
And that's significant, right? Because his view isn't just theoretical. He's actually managing one of the biggest, most visible corporate crypto stashes out there.
So the security concerns he's raising are very real, very practical for him.
You'd have to assume so, yeah. His caution likely comes directly from the challenges of keeping those assets safe day to day.
Okay, so let's recap Saylor's argument then. He thinks on-chain proof of reserves, publishing addresses, is a bad idea, mainly because of serious security risks.
Right. Traceability, exposing operational details, stuff that makes life easier for attackers and dilutes security for everyone.
And it's something he claims no serious security pro would recommend. Plus, that extra point.
That it's only half the story anyway. Shows assets, but not what's owed.
Right. So it's a partial picture at best, even from a transparency angle.
That really sums up his critique, yeah.
Okay, but then how do we square that with the fact that, well, the industry did adopt this, lots of big names started doing it. Why? It has these big security flaws he's pointing out.
Well, like we touched on earlier, it goes back to that desperate need for trust. Remember, the atmosphere after FTX meant Gawk's confidence was just shattered.
Right. The industry was really reeling. People needed something.
Exactly. And publishing those addresses, putting the data on chain where anyone could theoretically check it, seemed like a very direct, very visible way to say, look, we actually have the crypto.
It was a response to scandal, basically. A way to prove solvency, prove transparency, when people were deeply skeptical.
Mm-hmm. Companies like Binance, Kraken, OKX, even some of the ETF issuers mentioned, they saw it as a necessary step to show they weren't like the failed companies.
So you end up with this really clear tension, don't you?
Definitely.
On one side, an industry pushing for transparency, almost demanding it because of past failures.
And they land on this method, publishing addresses.
Which Michael Saylor, a major figure, argues is actually a huge security risk that makes things less safe.
It really highlights a fundamental challenge, I think, for the whole digital asset space. How do you balance that need for trust and verifiable proof?
Especially when traditional financial audits might not fit perfectly or be fully trusted. How do you balance that with the absolute non-negotiable need for hardcore security? Because in crypto, losing control of the keys is, well, game over.
Yeah. It forces you to question what we really mean by transparency here. Is showing everything always the best way? Could focusing just on holdings accidentally open up new ways to attack?
And it makes you wonder, are there other ways? Could there be different methods to give assurance about reserves, to prove solvency, without broadcasting all those sensitive operational details like specific wallet addresses?
This has been really interesting, digging into a view that honestly pushes back hard against what seemed like a settled step forward for the industry.
It's definitely a thought-provoking perspective and a good reminder that sometimes, solutions meant to fix one problem like a lack of transparency can end up creating new, complex problems of their own, especially when you're dealing with valuable assets in a pretty hostile online environment. Okay, so as we start to wrap up this deep dive, let's just quickly summarize that core tension one more time.
Sure.
You've got the clear industry move towards on-chain proof of reserves.
Yeah.
Driven by wanting to rebuild trust, needing to show verifiable holdings after disasters like FTX.
Yep. And then you have Michael Saylor's stark warning, no, this is a bad idea. Why? Because publishing wallet addresses creates traceability issues, weakens security for everyone, issuers, custodians, exchanges, investors, the whole chain.
Right. He painted that picture of the AI finding 50 pages of problems. And he added that kicker, it often only shows assets, not liabilities. So it's an incomplete picture anyway.
Exactly. And understanding that debate, that clash between transparency goals and potential security nightmares, it's really crucial if you want to grasp the challenges companies face trying to operate responsibly in this space.
Absolutely. Which, leads us to a final pretty provocative thought for you, the listener, to maybe chew on. If Saylor's right, if the main way we've tried to increase transparency by showing wallet addresses actually creates serious security holes, then how else can we build and verify trust in this ecosystem without compromising safety?
Yeah, what other ways could companies prove they have the reserves, prove they're solvent, without basically handing potential attackers a roadmap by revealing all those sensitive operational details?
It's a huge question, isn't it? Really gets to the heart of how this whole digital asset world might need to mature to build lasting trust.
It really does. Definitely something worth thinking about.
Well, thanks for going deep with us on that today.